Alright, here we go. We're going to be looking at uncollectibles today, and we're going to start with a quick review. What is a matching principle? And if you haven't, you should always be stopping and pausing to make sure that you answer the questions that are posed throughout the videos to test your understanding. In this case, matching principle is when we try and match expenses to the revenues that they generate inside the same accounting period. So here's some questions. What happens when accounts receivable can't be collected? How is the accounts receivable recorded on the balance sheet if we know that a debtor won't pay? In the ideal world, everybody pays their debts, but that's not always the case, and so we have a lesson on uncollectibles. When debts aren't paid, what happens? Well, when accounts become uncollectible, they can be written off as bad debts expense, an expense account created for uncollectible receivables. So we're going to be using this expense account in this lesson. The accounts receivable amount recorded on the balance sheet is the net realizable value. That's basically the value that we expect to collect from the receivables. So what we're trying to say is if we know that John Doe is not going to pay his debts, that we need to account for that on the accounts or on the balance sheets. And so there is something which we can do to make sure that we're accurately recording this. In 2012, businesses were doing well and sales were high. However, several sales are made on account. Unfortunately, in 2013, accounts receivable could not be collected and are expensed. This makes 2012 look really successful and 2013 look like a really bad year. How could we avoid this problem? We apply the matching principle, and we try and expense whatever we think we couldn't collect in 2012 attributed to 2012. We estimate how much won't be collected in 2012 and expense it in that year. So we don't wait until the following year when we expect to collect it. We try and expense it in the year that we expect we lost or was expensed. So there are two different ways to account for uncollectible debts. The first one we'll be exploring is the allowance method. It's an estimate of bad debts from uncollectible accounts at the end of a period. And we're recording an estimate of the uncollectible amounts as a percentage of sales or percentage of receivables. And this percentage in each case will be dependent upon the business, and they determine it based upon historical kind of going through and okay, we think that we're not going to be able to collect 5% of sales, so they come up with 5% based upon their historical averages. They write off uncollectible account, and then we're also going to be going through how to recover an uncollectible account. But if we wrote them off, we said they're not going to pay it, and then they actually do. Allowance for doubtful accounts is a contra account of accounts receivable. So a contra account could be something like we've got fridge and accumulated depreciation for that fridge. They are an example of a contra account, where a contra account is generally on the opposite side of the the opposite side of where we would expect it. So an asset is generally on the debit side, so a contra account will be on the credit side. Hopefully I got that right. All right. Here's an example. The sales for the month of October totaled $200,000, which is expected that 2% will be uncollected. So we're going to try and adjust for this 2% uncollectability. So we're taking this 2% came from the company's past history, and we're going to take 2% of 200,000, which is $4,000. So what are we going to be doing with this? Well, we know one of them has to be an expense. Maybe we have doubtful accounts expense here. And on the second part, we're going to have, well, what are we writing off? What do we have to get rid of? Think about that. Pause and think. What should go for both of these? At this point, I hope you've paused and had a chance to think about what goes here. In this case, we've got bad debts expense coming from the 200,000 times 2% is 4,000. And the allowance for doubtful accounts is the new account which we just introduced in the previous set of slides. And of course, we have a little comment at the bottom to record an estimate of uncollectible accounts. There's another approach. We can also do this as a percentage of receivables, also known as the balance sheet approach. Aging schedule is, we take a look at the age of amount of a subsidiary account. A subsidiary account, such as accounts receivable, is a collection of all the receivables for the different people who owe the company money. The percentage of doubtful debts increases as the days outstanding increases. For example, if something was considered to be outstanding for 1 day, we have a pretty good chance that we'll get it. But if we're looking at something where a payment is past due for 120 days, that means they had it due and they didn't pay it for 120 days, that we think as time goes on, there's a very low chance of collecting that debt. Maybe they went out of business. So just to show that schedule from the textbook, we've got here's the customers that we're looking at, here are their totals, and here are the number of days outstanding. So if we're looking at this classification here, it says that 0 to 30 days, we have a total of $100,000, which is currently outstanding, or the amounts or totals from the accounts receivable. And we've got 31 to 60 days, 60 to 90, and what we start to see here on the bottom is this estimated percentage that we will probably not collect. And so as time goes on in each accounting period, these ones will slide to the right every roughly 30 days, because up here they're every 30 days roughly. By the time you get to over 120 days, we've got a total of $12,500 on the accounts, of which we expect we're not going to be able to collect half of those. So here are estimates of those totals. We estimate that we aren't going to be able to collect 5% of the 100,000, 5,000, 10% of the 50,000. That's the past due 31 to 60 days. And this is what's happening with the accounts. So what do we do when we want to write off the uncollectibles? Well, senior management at Sony originally sold $2,000 worth of computers to Sam's computer shop. Well, for which it's now 90 days past due. Maybe something happened to Sam. We don't know. But what we do know is it's past due. And it's not even like it's a little bit past due. It's 90 days. Maybe he missed the invoice. That could be a potential explanation. Senior management approves writing off the account. Journalize the adjusting entry for January 15th. I'd encourage you to pause at this point to try and think about which accounts will be affected. How would you do it? What amounts should be done? Now that you've had a chance to try and take a look at this on your own, let's take a look how we should be doing it. We've got allowance for allowance for doubtful accounts, which we'll be putting in as 2,000. And on the other side, we need to get rid of the accounts receivable off of the books. So we should have expected that our expense was already done in the previous one. Now we're actually clearing this off of the books. So allowance for doubtful accounts goes on as 2,000. We clear the accounts receivable off at $2,000. But what happens if Sam's Computer Store, they do actually pay? What do we do to reverse that entry? And that's exactly what we're doing here. We're reversing an entry. So we originally wrote it off as being a bad debt, but magically Sam gets better, and on February 7th, Sam's Computer Shop pays Sony $2,000. We no longer have an accounts receivable. What do we do? How do we do the adjusting entries for this? Again, I encourage you to pause and think, what accounts are going to be affected here? After you've had a little bit of time to think, I hope that you've realized that this will have two journal entries, or a compound, no, it's not a compound entry. We're not doing more than 2 lines for each one. You could do a compound entry, but I'm going to show you as 2 entries separately. So the first one is, we need to take that doubtful account that we originally did in the previous set of slides, and we need to reverse the entry. We're going to reinstate or re-put back the accounts receivable that we originally wrote off as a bad debt expense. A doubtful account. It's not an expense in the last one. Here, we're taking our $2,000 and we're saying, okay, we're making it so that Sam originally had an accounts receivable and it was $2,000, and now all of a sudden he pays it. So what do we need to debit and what do we need to credit? At the same time, we're going to be coming down here. If we're receiving cash, we're going to be debiting bank. It's $2,000. And we're going to be crediting accounts receivable because we're now clearing it off the books. We need to make sure that that was not accounted for as an allowance for bad debt, because it actually turned into something that was a good debt, and they paid it off. That concludes our lesson on uncollectibles. I hope you've enjoyed. Here are some questions which you can take a look at and try and do on your own. I'll be updating Wiley as we go, and hopefully I can get more done so that you guys know exactly what you're doing. Good luck! And again, if you have any questions, please don't hesitate to email me.